I'm Eddie Sunderji, and welcome to YourFinance.tv. We are back with TPW Advisory's one and only Jay Pelosky. Jay, welcome back.
Marty, great to see you, buddy. I haven't seen you in a while. Congrats on YourFinance.tv. Very excited to be a part of it, and great to be talking with you.
You as well. And we're very excited to have you. We're excited to be here. And on that note, don't forget, viewers, subscribe, like, it's all down there and it's all got to be action. So you make sure you stay on top of all this content that we're putting out there. Otherwise, you won't get to see Jay anymore. So, Jay, we're here with your Friday musings. It's been, as usual, a headliner week with things moving one way then the other, and the Fed doing this and the Fed not doing this, and inflation, not inflation. Well, we're here, and you're going to break it all down for us. But before we dive in, give me a little run up to this week's title. And the title, for those who don't know but should know, is Firebreak. Where has this come from?
Yeah, Firebreak, right? Well, it seems as if we have these wildfires breaking out in the markets, particularly in the financial sector, and just kind of going back and forth between the US and then Europe with Credit Suisse. And then we kind of felt like Europe was under control. And we come into the office this morning, Friday morning, and we're reading about Deutsche Bank. So it's like almost like a wildfire, right? And when you think a wildfire is put out, there's maybe smoke, but no actual flame, but it can burst back into flame and keep going. And that, kind of is the Deutsche Bank of today. And so it struck me as I've been thinking the last few days about, the title and what to write about. And my brother, Kevin, who is works for the Mass kind of Parks and Forestry Service, actually sent pictures of a controlled burn that he led a few days ago. And so Firebreak comes from that, from Brother Kevin. Thanks, Kev. The idea of a fire break, either a kind of a area where the combustible fuel has been removed to stop an ongoing fire, or to kind of control the parameter or perimeter of a controlled burn. And so it strikes me that the environment that we have actually could be kind of construed as a fire break. And what I mean by that is, in essence, the failure of SVP, of Signature Bank, all the activity of Credit Suisse, all the activity is telling us very clearly that the Fed is not going to be able to raise rates until it gets inflation down to 2%, right? Inflation is at 6%, and the parts of the economy, and this is important, the parts of the economy that were big winners from zero interest rate policy and work from home, namely the tech sector and its financing arms, have shown us they're not capable of withstanding rates any higher than where we are today. Okay, so that in a way puts the Fed kind of in a box, and I think protects, importantly, and here's the idea of the fire break, it protects the rest of the economy from that risk of the Fed tightening and tightening and tightening. And so the vast bulk of the US economy, and I would argue the European economy as well, is actually being protected by the current activity, not destroyed or burned up or becoming really problematic. And so that's where Firebreak comes from, the idea that the failure of SVP and others have told the Fed that certain segments cannot take higher interest rates, and that puts the Fed kind of on hold, and we'll talk about that, I'm sure, but importantly, protects the consumer, protects the service sector, protects housing, and therefore actually reduces the risk of recession, not increases it. And I realize that's not what most people are saying, but that's what we think is actually happening here at TPW Advisory.
Okay, thank you for that. And obviously, you examine some of the market action this week. Can you run us through your thoughts on this?
Well, it's obviously been kind of chaotic, right? To put it mildly, the screen. I use terms like plate throwing. I use the term table tossing in my musings. So I think it's been that kind of a couple of weeks, right, where things have. Every day you come into the office, you're not really sure. Pre-open, it looks like it's going to be down big, and then within a half an hour, it's up, or it looks like it's going to be up big and half an hour it's down. I think it's been just wild action. But importantly, Marty, I think key sectors of the market have been able to hold in pretty well. And let's start with the S&P, which is continuing to fight for its 200-day moving average to stay above it, right? Which is right around 39.25, 39.30, somewhere right in there. And that's right where we were when I looked just 2 minutes ago. We were at 39.29 or something on the S&P. If you look at financials, XLF is trying to hold above that key support, which ties into the highs of pre-COVID. So right around $30 on XLF. And then EUFN, the European Bank ETF, remains well above its 200-day support level, which is around $16.80, and that's somewhere. I think this morning EUFN was around $17.50. So that too is well above its support level, notwithstanding the fact that it has given up all the gains it had for the year. But the S&P, you and I were talking about it before we went live. S&P is still up for the year. European equities are still up for the year. Japanese equities, Mexican equities, up for the year. So there's a lot of smoke. There's a little bit of fire in certain places, like the financials. But what's interesting is that big tech has been able to kind of compensate for that, right? Rates come down, tech actually does well, and that holds up the broader stock market, which is, again, tech was the problem last year. Now it's the savior. So it's back and forth volatility. But really, the more interesting activity has come in the in the fixed income space, right? With rates, where the MOVE index, which is the volatility index for the Treasury market, reached highs it hadn't seen since '08 at around 200, now back to 150. We're watching that really carefully because we think the fixed income market is driving the train here and is signaling concern about funding availability and things of that nature. We want to see that volatility come in within the MOVE index. Would like to see it around 100, 120. And that would provide support, we believe, for the equity market, which, as we just touched on, has impressed us with its strength, not the weakness, with its strength holding above key levels, notwithstanding, headlines that would make you shudder when you wake up and read the paper or look at Bloomberg first thing in the morning. So actually, in our view, pretty impressive equity stability. Volatility in fixed income needs to come down. Dollar weakness we see as a natural outgrowth of falling rates. And that, we believe, is supportive of our view that we want to be focused more on non-U.S. equity than U.S. equity for 2023.
Jay, before we roll into the next section, how are commodities performing?
Commodities have been weak as well. I think, taking their cue again from the fixed income market, right? Rates have had an absolute amazing decline, right? The 2-year Treasury has rallied 120 basis points over the last month. I mean, just off the chart type of moves. And I think a lot of people look at that and they say the market is pricing in recession. Bonds are pricing in a recession. So then you look at commodities and they take their cue, and you look at oil, and oil comes down sharply. And so commodities have come in. GSG, which is the ETF for the Goldman Sachs commodity index, that has been weak. That did break its 200-day support. and driven mainly by the weakness in oil. So that is a concern for those of us like ourselves again here at TPW that have been and continue to argue for what we call a middle path, right, between high inflation and deep recession. We continue to think that there will not be a recession in the US or in Europe or globally. And that is being called into question by the dive in rates, which leads to weakness in commodities. We don't subscribe to that because there are other things happening that would argue for a different outcome.
So, Jay, there's a lot of negative news out there. I feel like every pundit on the TV finds not just one or two, but 5, 10, 20 of these negatives out there.
Yeah,
so what
exactly.
are some, it makes your ears bleed after a while. So what are some of the positives out there that you see?
Yeah, and that's a great point, Marty. I mean, it's important as investors to maintain balance, right? It's important to have context. It's important to have a process. Again, you and I were talking before we went live. For us at TPW Advisory, it's really valuable to write every week, to do the musings every week. We hope and believe clients benefit from it as well, but we really benefit from it because it forces us to have, at least for a while, a coherent point of view, right? That we have to put down on paper. It has to read like it's coherent. And that gives us a fair bit of comfort because otherwise, as you say, there's like lots of negative news out there and lots of people, blood sells, right? That's the old line for the newspaper industry. It's the same in social media, times 100. But I do think, and we do think there are some positives. Let's start off with housing, right? Housing has bottomed in the U.S. and is in recovery. Both existing homes and new home sales have been up for several months in a row. And much as we've heard about the downside to digital bank runs, right? Oh my God, we just have to press a button and money flies out. Well, the same thing happens, Monty, in terms of booking a mortgage or nailing down a mortgage rate, right? When rates come down and mortgage rates, which were over 7, are today at about 6.5, probably going lower because they need to catch up to the sharp decline in the 10-year, right? People can press the button and lock in a mortgage. So you're seeing activity levels in housing in the US pick up reasonably significantly. And that's important because people have been saying that, rates go higher, home demand goes lower, lots of people who've been building houses get laid off, unemployment rises, consumption falls and blah, 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 blah till you get to recession. The reality is that housing has bottomed already. And we at TPW Advisory did suggest to our clients and did put into our global multi-asset model a position in XHB several months ago. And that remains up. We remain up on that position. What are some of the other things? Here's a quote I'm sure you and many people have not heard. And I read it this week in a Bloomberg article. There's never been a better time to build a factory in the US. Just think about that for a second. There's never been a better time to build a factory in the US. And that came from a Volkswagen executive who, like many, are building new plants in the United States, in Canada, in Mexico, to kind of take advantage of the climate provisions in the Inflation Reduction Act, IRA, which was passed by Congress and signed by President Biden earlier this year. And this is something we think is getting lost in all the day-to-day noise and the smoke and the fire of what's happening around certain financials in both the US and Europe. There is a huge, huge industrial policy rollout taking place in the United States and in Europe to deal with climate, right? And you see it from battery plants in Canada to the new battery belt in the United States, all the way down to EV production platforms, BMW, Tesla, and others in Mexico. So there's an industrial policy angle that's unfolding as we speak that people have not seen since the 50s, 1950s. And even I wasn't around in the 50s, right? People have not seen industrial policy since the 1950s in the United States. And so that's another really big positive that we think is not being appreciated. And then finally, we have Asia desynchronized from the US and Europe. No inflation concerns. China inflation's 1%. In Japan, it's 4%, but they welcome inflation. They've been trying to get it for, decades and decades. So Asia is actually leading a desynchronized global economy into recovery, not recession, recovery, right? China is going to grow 6% this year, the second biggest economy in the world, going to grow 6%. It grew 3% last year. Japan is growing. Southeast Asia is growing. So there's a whole rest of the world that investors can participate in that is growing. And we think that's going to be sustained because as the Fed goes on hold, we expect central banks in some of the emerging markets to start cutting rates. So we believe we're on the cusp of a rate cutting cycle, having finished one of the most aggressive rate tightening cycles that we've seen in 40 or 50 years. So to us, there's a number of positives, but they're unfolding kind of behind the scenes of all this day-to-day craziness. And that's why we think as this ebbs, and as we see that fixed income volatility come down, as we see inflation continue to come down, we expect people to start focusing on what's coming down the pike, which in our view is not a recession, but a global recovery driven by this CapEx boom to deal with the issues around climate in particular.
Well, Jay, it's actually really quite refreshing to hear some of these positives and the way you lay things out. So, that's a nice way to start the weekend, that's for sure. How about your outlook? What do you see is kind of unfolding next?
Well, and so we kind of just gave the medium-term outlook over the next couple of years that's unfolding, we think, globally, right? Because climate, there's nothing like climate, right? Every country in the world is spending money to deal with climate mitigation between now and 2030. It's the single biggest global macro theme that we believe exists. And so we pay a lot of attention to it. And it's one of those things through our TPW 20 thematic model, right? We have the global multi-asset model, which is our flagship, and then the TPW 20, which is a thematic model, which climate makes up about 40% of that model. We pay a lot of attention to this stuff, and I think that's why we can see it unfolding while others are just focused on the day-to-day churn in the markets. But in the very near term, we expect a couple of things, Marty. We do think the Fed is going to go on hold after the rate hike of this week. We think that's pretty much going to be it for the Fed, in part because we think inflation is going to continue to fall significantly over the next couple of months. Keep in mind that March and April last year was when all the inflation and energy and food prices took place because of the Russian invasion of the Ukraine, right? So those numbers drop out. The year-over-year inflation numbers are going to come in significantly. And then in the second half of the year, we think shelter costs are going to decline significantly. We already know they have, right, in terms of rents and things of that nature. It just hasn't caught up to the CPI designation. So we feel pretty confident that inflation is going to continue to decline. It may not it's not going to get to the 2%, but I think it's quite feasible that we're going to be around 3%, maybe a little bit north of that by the end of the year. And we think the Fed is going to effectively declare victory at that point. It may not say we're going to have a new inflation target, but it's not going to push to 2% in our view. So as that occurs, we expect continued dollar weakness, and that should be supportive, as we mentioned, for non-U.S. equity, as well as for commodities. We want to see that volatility in the fixed income market ebb, as we touched on. That's really important. We think the Fed going on hold, inflation coming down, is going to be the thing to really watch. We think the next big data point, now that we've gotten through the Fed, is that upcoming March CPI, right? In a couple of weeks, early April, we'll get that data point. And that, I think, could put a very different outlook on the table, assuming that, you know, the bank issues kind of ebb and fixed income volatility declines. A nice soft inflation number could really perk markets up a fair bit. And so, as we touched on earlier, to me, if I was bearish, I'd really be concerned, because I think if you're a dyed-in-the-wool bear, you have to actually ask yourself, what could be worse than the headlines we've gotten in the last couple of weeks? It's going to push this market, you know, 500-600 points on the S&P lower, which is where a lot of bears have been, you know, calling for that 3,200 type level, 700 points below where we are today. I just find that really hard. And so to me, it's almost, I think as we move forward, we're going to see a more constructive environment, as we've touched on. Obviously, bears feel differently, but I just wonder, you know, I'm actually kind of happy that I'm not super bearish, because if I was, I'd be sitting there going, oh my God, what do we need to break this market? And so our outlook remains pretty constructive. We continue to favor non-US equity, as we have for the last 6 months or so, a mix between Europe and Japan and the developed market, and then Mexico to benefit from that reshoring we touched on the climate side, as well as China and Southeast Asia, driving that China growth to 6%. We think commodities are interesting, given our view, as I just laid out, right? Commodities probably are interesting around these levels. And we continue to hold to our financials position. We have not sold anything from our EUFN position, and we don't intend to. And we continue to hold the position in XLF as well. To us, this is not systemic on either side of the Atlantic. And so we expect that the benefit is the short-term pain is the volatility of the last couple of weeks. The benefit is the firebreak that we think this has instilled, protecting the broad economy in the US and Europe, the consumption, the service, the housing side. And that's going to allow us to carry through without recession. And so we'll end the year with higher equity prices, particularly outside the US, than what we have currently.
Jay, that is almost a heartwarming, constructive recap to end the week with. So I very much appreciate it. None of this naysaying stuff. And unfortunately, I'm sure we'll still spend a lot of the weekend watching these headlines come across as and when they do. But a lot to digest there. Thank you very much for sharing your thoughts from TPW Advisory.
Appreciate it, Marty. Always a pleasure to see you, my friend.
And we'll see you soon. And for our viewers, don't forget to like and subscribe, and make sure you stay on top of all this content. And keep on trucking, and good luck in investing in these markets.